I'm joined by Haag Sherman, who oversees more than $7 billion in assets as Chief Investment Officer at Salient Partners. Thank you for joining us this morning, Haag. Let's talk first about this BP asset sale. We keep getting bits and pieces of news here. What kind of prices can the company get, given that it's essentially holding a fire sale of its assets to raise cash?
No, that's a good point. They are under significant duress to raise capital to pay for the spill in the Gulf of Mexico. So if you look at the T&K, the possible divestiture of those assets, and also the Colombian assets, they do have to sell these and sell these quickly. There's a limited number of buyers. There's only one for the Russian assets in effect. And also, if you look at the list for Colombian buyers, the list is short. So you know that they're having to divest of these at a fire sale just to raise cash for the Gulf of Mexico spill.
And there's political risk as well when you're talking about Russia.
Exactly. And no one knows better about this risk than Bob Dudley, who in 2008 was forced out of the T&K BP joint venture under interesting circumstances. So going back along with Lord Brown to go and talk to the Russians about this joint venture, I think means there's something on the horizon. Potential sell back to the Russians of BP's portion of the joint venture. Again, probably not at a high price, but at a price to raise some cash.
Right, and they want to do this, obviously, as quickly as possible.
That's exactly right.
Okay, let's also talk about the scope of the oil spill, because we've gotten some numbers, and it's now pretty much official that BP spill is the worst accidental oil spill ever. 4.1 million barrels of crude during an 87-day span.
Yes.
That eclipses what we've previously known. Can you put that into perspective for us?
If you put into perspective, the other one that we have to measure this against is the Exxon Valdez, where the spill was largely contained to what was in the tanker. In addition, Prince William Sound, much easier geographically to clean up, more contained, rocky shores. If you look at the BP exposure, a much bigger spill spread across a much bigger area. Some dissipation of the oil, but cleaning it up from the marshlands is going to be much more difficult than cleaning up the rocky shores of Prince William Sound.
Yes, certainly it's kind of unprecedented, really.
Yes.
Now, we just got some results from Marathon Oil, and it looks like earnings per share beat analyst estimates. We've heard a lot of this kind of theme from the big oil companies that reported. Crude oil's increase in the second quarter helping to lift profits.
Yes.
People are saying that crude oil's price increase will start slowing in the second half of this year, and that'll start eating into the earnings growth story.
I think that it will slow year over year just because the target's increasing year over year from 09 to 10. But it's something Betty and I talked about in March, which is the risk trade, or the dollar, has played a significant impact on the price of oil. So anytime you see the dollar weakening, the risk trade coming back on, you start to see energy prices inflate. So even though the year-over-year increase won't be nearly as profound in the third quarter, you still see nice numbers because I think that energy prices will remain high throughout the rest of the year.
Okay, let's look over to deal making in this space. We talked earlier about BP, but beyond BP, the M&A outlook for drillers in the wake of this oil spill. Who makes an attractive takeover target at this point? I know you had a couple of names.
Well, I think aside from the drillers, if you look at the E&P companies in the Gulf, in particular, you have one that stands out as an acquisition opportunity. It's under duress because it's a smaller E&P company, ATP. Its stock has been hit lately because its drilling program has been abating.
You can see the stock price right there.
And so, in effect, their balance sheet needs to be restructured. They have too much debt, and they provide an attractive entree into the Gulf of Mexico, either to consolidate with some larger holdings with a better cost of capital and a much better balance sheet, because drilling costs are going up in the Gulf. With the recent congressional action or proposed action on lifting the cap on liability, insurance costs are going up, and only the biggest will be able to drill in the Gulf of Mexico. So it makes companies like ATP very vulnerable.
I see. Okay, and when you say only the biggest, we're talking about the same big oil companies that keeps coming up in every discussion, right?
Absolutely, yes.
The Exxon Mobils of the world. Thank you so much.
Thank you.
We've been speaking with Haag Sherman. He's the Chief Investment Officer at Salient Partners.